Non-qualified accounts, such as an individual or joint account, have a litany of potential tax implications. From tax-free interest in municipal bonds to capital gains to dividends, these can be often quite confusing to clients. Let's dive into the tax ramifications within a non-qualified account. All right, so Spencer, top of the ticket today, we want to talk about non-qualified accounts. What we're not addressing is your IRA, your HSA, some of those other tax-deferred accounts, or even your Roth IRA, that's the tax-free growth account. We're specifically talking about your non-qualified account, those individual joint accounts that are going to be taxed on a year-to-year basis. Now, there's certain different types of investments that you can hold in these accounts that are going to get taxed in different ways. But what we want to do is look at, when you look at that statement from your non-qualified account at the end of the year, you'll see things like dividends, capital gains. So we really want to explore, what are those different tax implications? So let's start off with dividends. Can you walk us through what is a dividend and how is it taxed?
Well, dividend is a payment from a company to shareholders. So the company does well, they have some level of profitability. At some time, their board of directors says, well, we want to return this to our investors because we don't have enough great ideas of how to expand the company and just reinvest those funds. So they pay out a dividend. If you own the stock and you hold that stock for a period of time, usually 60 days before the dividend is paid, is generally what you need to hold it there. Although there's some fine print and some different ways that you need to make sure that you're working with your accountant on this. But generally speaking, you own it for at least 60 days prior to that dividend coming out. It's a qualified dividend. So it just means that you've held it long enough that the federal government is going to give you a little bit of a tax break. You're a long-term investor. You're not trading things, frequently, for instance, there. So a qualified dividend is taxed at about the same rate that long-term capital gains are taxed. So we have a certain amount of income that you might be able to have that if you're south of that in terms of your taxable income, you would have 0% as the tax rate there. For middle income earners, it would be 15%. And then for the highest income earners, it would be 20%. Now, you also have net investment income tax. That's a conversation for a different time. But if you're north of overall income, at a certain level, you have an additional 3.8% tax just on that extra amount that's above that certain threshold there. So, but the big picture again is that those qualified dividends, if you jump through the particular hoops, if you're a long-term investor, generally speaking, you're going to be taxed at a lower clip. Right. For those.
Right. And so we want to say, if you have non-qualified dividends there, those are taxed at your ordinary income rate.
Right.
So there's a slight difference between those qualified and non-qualified. So if you don't meet the holding period, or there's just other instances where if that is a non-qualified dividend, then you will have it at your ordinary income rate.
Which can be a substantial difference. You think if you have a high level of income, let's say you have $750,000, of income in a particular year, you could be taxed at a 20% rate versus a 37% rate. Yeah. So almost double the taxation there in some circumstances. Yeah.
Okay, so let's move on from dividends to looking at capital gains. So we've got short-term capital gains, long-term capital gains, and these again are taxed at different rates. So walk us through, what's the difference between a short-term gain and a long-term gain?
Well, as the name implies, a long-term gain means that you have held the stock for over a year. If you have a short-term gain, you've held it typically for less than a year. So that could be an individual stock. It could be a mutual fund. It could be an ETF. It could be really any kind of investment that's out there. If you've held it for less than a year, that capital gain, just say, you put $100,000 into some investment, it goes to $110,000. You have $10,000 of gain. Well, now the only question is it a long-term gain or is it a short-term gain? There. So that, again, line of demarcation is 1 year. If it's north of a year, then you've got a long-term gain. If it's south of a year, you've got the short-term gain. And that short-term gain, again, like we talked about, it's taxed as ordinary income. So the tax brackets tend to be far higher than we would look at for what we were talking about there for qualified dividends.
Right. And so this can be really messy for investors, because let's assume that you are on a automatic reinvestment of your dividends. You are still going to be taxed on those Or if a mutual fund decides to pay out capital gains at the end of the year, you have no control over what that mutual fund does. And so you have not sold the stock, but the mutual fund company decides that they're going to churn if it's an actively managed fund. So you may have a tax bill that's due, even though you have not actually taken any of those funds and put them in your pocket.
Right. It's a great point. So let's just say you invest in a mutual fund and it's, the fund itself invests in 3 different companies. And by the end of that year, they say, well, we've done really well in this account. We're up 50%. And what we think we need to do is sell these 3 companies and buy 3 other companies. Well, they may have held those firms for only, 7 or 8 months. Now you're probably happy because you say, okay, 50% gain in 7 or 8 months, maybe I'm okay with the tax bill on that. But the tax bill can be really punitive.
Right.
So that's why a lot of folks have gone more towards the ETF side of the world that has less uncertainty than, say, the mutual fund side of the world with these kinds of distributions and intra-year capital gains distributions, because the way that the ETFs are structured, that's very uncommon for the exchange-traded funds, whereas it's much more common for a mutual fund there. So we have to be really careful, because we do see clients that they might have $250,000 in one particular mutual fund, and there's a changing of the guard. The manager may retire, a new manager may come in and say, okay, I don't like half of this portfolio, I'm going to sell it off. Well, if those particular investments had seen huge gains, say they bought Apple 20 years ago, and they've seen thousands of % of gain, in that, then that can generate a tax bill, even though you still hold the same mutual fund.
Right.
So we had to be really careful about how we do tax planning in these non-qualified accounts.
Absolutely. Okay, so let's then, one thing that we could always look at in a taxable account is if you have long-term gains in one fund and long-term losses in another, there could be opportunities to do some tax loss harvesting. We're not going to get into the nuance of that, but just know that, let's say you've got $10,000 of gain, you've got $10,000 of loss in a different position, you need $20,000. You could sell them both and essentially eliminate that gain with those losses.
Yeah, the other thing that, of course, we can always do with tax loss harvesting is if we have a loss and we're happy with our other positions just holding them, if we sell and we harvest that loss, we can take up to $3,000 of that loss and apply it against ordinary income. So for someone that might have taxes that are at a 35 or 37% level, if they can sell some of their resources that are at a loss and then translate that against their ordinary income, it can be a nice tax benefit. Again, it's not going to save them a tremendous amount, but somewhere north of $1,000 oftentimes.
Right. Okay, so let's shift now to our final bracket, which is just interest. And this is going to be one that's a little bit more similar to most folks, but what do we need to know about interest income within a non-qualified?
Well, interest income, there's 2 types, essentially. You have taxable interest and you have non-taxable interest. So the taxable interest, as you might think, if you have an investment in U.S. Treasury bonds, or you have an investment in corporate bonds, and those are paying out interest income, then that's going to typically be added to your ordinary income. And, you're going to calculate that, work with your CPA, file the taxes accordingly, but you're going to be taxed at your marginal tax rate there for ordinary income. If you have municipal bonds and the income is tax-free, then you won't have that applied to your ordinary income, but it still can have some other impact there. It can have an impact on your income-related Medicare adjustment amounts, your Medicare surcharges there, because that level of income is added back to your adjusted gross income to create this modified adjusted gross income, which is what the thresholds are then determined, for what your surcharges or your extra premiums are there. So we got to be careful as we do tax planning to include that in some aspects, but also not in others.
Right.
That interest income.
Right. All right. So let's look strategically at the different types of investments that we could put into a non-qualified account. What are maybe some of the most tax efficient, and what are some of maybe the least tax efficient?
If we look at the least tax efficient, start there. Let's pick on real estate investment trusts, REITs, because most of the income that's generated by a REIT is going to be taxed as ordinary income. It's going to be interest income, essentially. So we oftentimes will not want to put REITs in those non-qualified accounts. It would be better to put them, generally speaking, in a Roth IRA or traditional IRA if we have all three kinds of accounts, or even to put them in a non-qualified variable annuity if a client has one of those types of accounts. Because in those other types of accounts, we're not taxed as we receive that income. Instead, we're taxed on distributions from, say, a traditional IRA or from a non-qualified variable annuity. So if we have REITs in particular and other kinds of investments that pay off a high clip of interest, we think about, for instance, direct corporate lending. If we've got loans that are paying us 10, 11, 12% in a fund, ideally, we wouldn't have that in a non-qualified account. Now, sometimes we need to have it in a non-qualified account for other financial planning purposes and as we manage resources. But if we look at the tax planning side of things, oftentimes it's best not to have those resources there. Another kind of investment that pays an interest essentially for its income or for its total return would be reinsurance. That's an investment that can be really helpful and profitable for clients, but the way that the returns come, they're not coming from capital gains typically. Typically, they're coming as interest income. So these are the types of investments that, again, if we could, we'd say, well, they're growth investments, and so we might like to put them in Roth, or if we don't have Roth IRA resources or only have a small amount there, then they might be best in a traditional IRA overall. On the flip side of things, you asked about those investments that are the most tax efficient, and these would oftentimes be U.S. equity investments, can be international equity investments, and if we had our druthers, they'd have even a low level of dividend payment. So Berkshire Hathaway is famous for having no dividend. There's just a reinvestment, of funds. Warren Buffett, as he's managed Berkshire Hathaway, he has plenty of cash on hand to be able to acquire different firms. But what he's not doing is paying out a dividend then that has to be taxed. Instead, typically what's happening is he is allowing his overall assets in the firm to continue to grow, and therefore most of the gain is taxed as a long-term capital gain for those long-term investors. Now, there is a level of reinvestment within his own stock, and there is some corporate tax implication, for that. But generally speaking, their strategy is to be one that offers their investors that long-term capital gain rather than paying out dividends on a consistent basis.
Right. So one that you didn't mention there, Spencer, is fixed income resources. If clients only have a non-qualified account, they're going to need to hold fixed income in there. So how do we think about fixed income within non-qualified accounts versus other types of accounts?
Well, we want to look at a client's marginal tax rate. If a client is in the, say, 22% marginal rate, then we look at taxable bonds versus municipal bonds, and we may say, well, the taxable bonds are pretty attractive in their yield versus these municipal bonds. If we start to see clients in higher tax brackets, oftentimes that's when, and particularly if we have state taxes that we've got to think about as well, we don't have those in the state of Tennessee now that the dreaded Hall tax, hated that name, the dreaded Hall tax is gone. So we don't have any of those state taxes on these kinds of gains or dividends or what have you. So as we look at that, if a client has a lot of income and an additional amount of taxable income from bonds would just add to that at, say, a 35 or 37% marginal tax bracket, then municipal bonds might be far more advantageous. Municipal bonds, too, they're just different than, say, the governmental bonds that you'd see, the U.S. Treasury bonds or the corporate bonds. There is a different dynamic in terms of the issuance and the interest rate. And so sometimes, even if a client's not in a tremendously high tax bracket, it can still make sense to invest in municipal bonds just because they seem to be a pretty good value in a certain season. But generally speaking, what we look at there would be clients that are paying a lot in tax. We want to make sure that they have the option of investing in some municipal bonds so that they're not increasing that tax load. And then those that don't have a particularly heavy tax load, we may just have them more focused on taxable bonds because yields may be higher there.
Right. Spencer, thanks for walking us through taxation of different types of investments and how each of those can be taxed differently. Clients, if you have a non-qualified account and you want to talk to us about what your tax implication would be, we would love to walk with you through what the investments that you have in your accounts are and what the tax implications could be for those. As always, work with your CPA to get tax projections. And if you have questions, feel free to leave them in the comments below, and we'll see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.